5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to the Follow the Money podcast. I'm Jerry Robinson. This is episode number 501, entitled 2026 Market Outlook, and it is the first episode of 2026. It's so great to be back with you after a nice holiday. I hope you had a wonderful time with friends and family over the Christmas holiday and the New Year's holiday, and here we are. 2026 is already off to a wild start, right? And every single new year brings the same temptation to predict and to guess and to look for certainty in a world that just simply doesn't offer it, right? Markets are always changing, the economy is always shifting, and the narratives are always coming and going. So today, when I talk about the market outlook, we're not really talking about predictions per se, but much more about positioning, right? Good positioning ahead of this new year. And over the past few weeks, I've been putting together my complete 2026 economic and market outlook for our members here at Follow the Money. And it includes all of the big economic forces that we see in 2026, right? The investment themes that we're looking at, we have 9 investment themes that we're focused on this year. And the ones that I think that matter the most, I put in this report. We've also listed out about 6 economic forecasts, and we also shared many stocks that we like, our favorite stocks for 2026 from all 11 S&P 500 sectors. And so today, this episode is basically a preview of that. You may recall at the beginning of 2025, we did a similar episode where we kind of broke down some of the basic ideas that were in our 2025 market outlook. And by the way, that turned out to be really good. We went back and reviewed that at the end of 2025, and we were really impressed with the things that we saw and how things went in 2025, although it was a bizarre year. I suspect we'll have similar things happen this year, lots of volatility likely ahead. Now, of course, I'm not going to include everything or cover everything that we put out in this brand new PDF report. And also we have a video that goes along with it. This is for all of our members. I'm not going to share everything here on this podcast. I'm not going to talk about the full framework and all the stocks and every single theme. That's all reserved for members. But what I do want to do on this episode is kind of share some of my clearest thinking as we head into the new year. The backdrop is basically this. We have inflation that's cooling. It's not disappearing. We have interest rates that are likely heading lower in 2026, but not all at once, right? It's going to be a steady decrease. The U.S. dollar continues to soften, but it's not collapsing. And artificial intelligence and robotics are moving out of the realm of hype into having a real economic impact upon the U.S. economy. And so that combination is really what I believe is really going to set up some opportunity, right? It's going to also create a bunch of noise. And most investors lose money, not because they're uninformed, but because they react emotionally to all the noise that's in the market. And so in today's episode, I want to walk through 3 economic forecasts shaping my outlook for 2026. We'll also talk about 3 investment themes where I expect outperformance. Specifically, these are themes that I think will beat the S&P 500 index in 2026. And then I'll share a few of the stocks that I'm watching most closely this year. We have quite a large list of stocks. I'm just going to share, just a handful with you on this broadcast. But with all that said, let's start with the economic backdrop because everything else flows from there. Let's get started. All right, so let's start with the economic backdrop as we head into 2026, because if you get the macro wrong, you can still make money, but it's just more difficult. If you get the macro mostly right, it becomes a little simpler to stay calm and to be well positioned, right? you don't get shaken out of your position. So I'm going to give you 3 economic forecasts that are shaping how I'm thinking about this new year ahead. Begin with forecast number 1. That is, the US dollar index will continue falling in 2026, just not as much as in 2025. So basically, I expect the US dollar to remain in a downtrend in 2026 for the most part. I just don't expect it to repeat the magnitude of the loss that we saw in 2025. And I'll explain why in a second, but when we went into 2025, one of my primary forecasts was the dollar was going to come down, right? And that's exactly what we saw in 2025. In fact, it may have been one of the biggest economic stories of the year was how much the US dollar, which is supposed to be a fairly stable asset, right, came down so sharply in 2025. Now, I expect more of that in 2026, as I mentioned. And the reason is because it has to do with interest rates, right? And capital always flows to the rate of highest return. Some people say that capital flows to where it's treated best. Well, that's usually the highest return, right? And in 2025, the dollar had a lot going against it. It had tight policy at the beginning of the year that was beginning to ease. The U.S. deficit picture was incredibly ugly in 2025. So that didn't help at all, right? We've seen massive amount of spending in 2026, and it's like wartime spending or pandemic era spending, and we're not even in a pandemic or in a global war. And so it's pretty nasty, right? And then we have, global capital that began to look for diversification. And I don't think any of those forces are really going to vanish in 2026. I just think the pace is going to cool a bit. So the biggest driver this year is that we are going to see, at least for the dollar coming down, is the rate cuts, right? So President Trump is supposed to announce a new Federal Reserve chair some point this year. And it is very likely not going to be Mr. Powell, right? Mr. Powell's on his way out, even though Trump handpicked him, back in, was it 2017 or something like that? Well, either way, he's done with Mr. Powell now, so he's going to pick somebody else. Maybe Kevin Hassett, maybe Warsh, we'll see. But regardless, we expect the Fed to cut 3 to 4 times in 2026. Now, that's exactly what we had expected in 2025, by the way. We had announced we expected 3 to 4 rate cuts in 2025. We got 3. So we think we're going to see the same thing again this year. And if the Fed cuts 3 to 4 times and other central banks also cut, the dollar can still drift lower, but the interest rate advantage that was supporting the dollar earlier in the cycle becomes a little less dominant. That basically changes the flow. So what I'm basically saying here is that I don't expect a collapse of the U.S. dollar in 2026. It's not the end of dollar dominance as we speak. People love dramatic narratives. The thing is, the markets usually move in cycles. They don't usually just fall off of a cliff, right? So what does that softer dollar in 2026 mean for you? Well, it tends to support risk assets. It also tends to support hard assets and commodity prices, right? So it also tends to support international stocks. So it basically acts as a tailwind. When the dollar's dropping, it acts as a tailwind for things that are priced in dollars, right? And the practical takeaway is kind of simple here. If you have a weakening dollar backdrop, that tends to reward diversification away from, strictly U.S. assets. It does not mean that you abandon, U.S. stocks. It just means that other areas of the globe are going to do well. Or they have the opportunity, to do well. So it also means that you should pay attention to things that historically do well when the dollar drifts lower, right? And I'll be talking about some of those things as we get into our investment themes. So that's the first forecast. We think the dollar is going to come down in 2026 again, largely due to rate cuts, which is the price of money. But we don't expect it to come down as much as it did in 2025, right? Time will tell. We'll see. Okay, our second forecast I want to share with you on this broadcast today is that we expect, and I already mentioned this, but that interest rate cuts, I should say, will keep asset prices elevated in 2026. I expect 3 to 4 rate cuts again this year. Now, this is one of those that people often misunderstand. When you hear somebody say that they expect rate cuts your brain is kind of trained to think recession, right? Or crisis, or something is breaking. And sometimes that's true, just not always, especially in this zany world we're in now. So in 2026, I can see the cuts, coming certainly toward the beginning of the year. We would see some in the beginning, maybe a bit in the middle of the year. But really what we're moving back towards is some sort of normalization. You see, inflation, at least the headline CPI numbers have cooled enough to where the Fed can really kind of ease rates without losing face. When rates are high, obviously that is going to attract those who have cash and they want to put that cash to work, maybe in the bank or something, and get a CD yield that's high. Basically, investors get paid to sit on the sidelines when rates are high, right? But basically that pulls money out of risk assets. Now, when rates fall, like I'm telling you that we expect in 2026, the math changes. See, cash becomes less compelling. So suddenly you no longer are wanting to leave that cash in the bank for a lower interest rate, right? So that ends up allowing people to begin to move money out of the bank. Remember, we have like the $7 or $8 trillion in money markets right now. It's one of the highest that we've ever seen. And so that money is going to come out as interest rates lower. And that's probably going to, part of it, not all of it, but part of it's going to go into more risk assets, and it's going to drive asset prices higher. So that's why I keep saying that 2026 is really not about, thinking that things are just going to go up in a straight line, but rather that we're going to have a floor under asset prices due to these interest rate cuts. And that may surprise people that the asset prices are able to stay resilient. Will there be volatility? Of course, right? You've got to factor that in, and we're going to have some volatile moments. Think back at 2025. I mean, April, we saw the NASDAQ, down like 20% at the beginning of the year after the tariff announcement. Then it closed nearly up 20% on the year, so it was very volatile, and yet we resolved higher. So that's what I'm saying here. We can still have rate cuts and then also, scary pullbacks, right? We can have volatility. You can still have supportive policy measures and then still get, scary headlines, lots of noise. But, the overarching reality is that if you ease financial conditions by cutting rates, that just tends to support stock prices and risk assets in general. So while I'm not saying that rate cuts are going to guarantee stock market gains or hard asset gains, they usually increase the probability that risk assets are going to stay supported, especially if the earnings hold up. And that's something that I also expect this year, is that we're going to see another outperformance in corporate earnings, just like we did in 2025. Many companies have gotten lean in the post-pandemic era. They've gotten more efficient with AI and other things as well. One more thing I might mention regarding all of this is that, there's some psychological things to keep in mind too here. When the Fed moves from hiking rates to cutting rates, the market's mood begins to shift, right? We begin to see that more liquidity is just going to push, asset prices higher. It tends to raise multiples, at least for a period of time. So the investment takeaway here is that you don't want to fight the liquidity. We think there's more liquidity coming into this market in 2026, and that's going to raise asset prices once again, albeit with volatility, albeit with pullbacks along the way. Nothing goes up in a straight line. So when monetary policy turns friendlier to you towards asset holders, you want exposure to those areas that benefit the most from improving liquidity and falling rates. And so that's definitely something we see coming. More rate cuts this year. Obviously, the dollar is going to come down as a result of that because interest rates are tied to the dollar. Now, finally, third forecast I want to share with you before we move on is that once again, we expect in 2026 for AI and AI-driven robotics to continue to dominate the global economy. And we are still very early. This is a very important force in my view. And I think that some people have kind of discounted how important AI and robotics is really going to be to the global economy. We mustn't think about AI as simply just another product. I mean, it really is something that is transformative in our economy. We've already seen the first wave of it. We've seen generative AI. Everybody's been on ChatGPT or Google Gemini or Claude or whichever of the LLMs you're using out there. We've already seen it in, the ability to create text, to create images that are stunning. We've seen it, basically to start writing code, summarization. We've seen productivity tools coming out of this, but this is just the first wave, right? This is just the first wave. The next wave is going to be even deeper, and we're going to be seeing it in 2026 and beyond. This is where AI begins to integrate with business applications, logistics and manufacturing and customer service and finance, drug discovery, which is going to be amazing, cybersecurity, which we already are seeing quite a bit of that. Everything is going to be impacted by AI. And then robotics takes it from digital to physical. That's where the real productivity impact gets very serious, because AI-driven robotics means that machines can no longer be programmed, they're trained. So they can see and they can decide and they can act in real environments and not just repeat the same motion that they've been programmed to do over and over. So it allows them to learn and be trained. So this is going to change, our economy. It's going to change manufacturing. It's changing warehousing right now. We're invested in one stock that is transforming warehousing through AI and robotics, right? It's going to change, transportation. It's going to change delivery. It's going to change the cost structure of entire industries. So when I say that this AI era and robotics era is just still in its infancy, I really mean it. Most companies are still experimenting. They're still in that experimental phase. Most governments are still trying to understand the implications of what AI is. And a lot of the regulations around this, including self-driving vehicles, there's still, a lack of political regulation around these things to help, businesses understand. So we're still very, very early. Most investors are still thinking in terms of last decade's playbook. They're not fully aware of what's actually happening. AI and robotics are the new playbook, right? Now, when a theme is this big, this kind of investment theme, it tends to attract hype, right? Everybody starts labeling everything as AI. People start putting AI in there. Remember the dot-com bubble? It's the same thing. Valuations can get out, way overstretched. Some companies are going to get exposed in 2026 as, just pretenders or whatever. But that's why you don't buy the whole kit and caboodle. Instead, you buy the cash flows, right? You buy the companies that have moats. You buy the companies that have real infrastructure, real businesses, real product backlogs, all of this that have real solid fundamentals. It's important that we be very, very careful not to get caught up in the hype of this, because even though it's real, you can get caught. And just think about crypto. Crypto is a perfect example of something that was real, but so much hype was around it that people lost money, getting all piled into these crazy projects that were just kind of pretending. They weren't even real. So if AI and robotics do what I think they do, or they're going to do over this year and the coming years, I expect that we will see an increase in productivity that's incredibly meaningful over the next decade or so. And productivity is how you grow an economy without creating inflation. In fact, increased productivity can actually have deflationary pressures. And that's a huge deal for us, where we have such an inflationary economy. So, in the long run, I think the most bullish economic story is not the cheap money is returning, because that's obviously bullish, but it's the rising productivity that's going to go along with it that could have a very powerful impact upon our economy. So AI and robotics, as I mentioned, are just basically deflationary forces in many ways. They lower costs, they accelerate output, they improve efficiency. So the investment takeaway is this: you want exposure to the winners of this shift into AI and into robotics. And you want exposure to the second order beneficiaries as well: the power demand, the chips, the cloud, the infrastructure, the cybersecurity, the automation, right? All of these different areas are just ripe with opportunities for smart investors. So we'll talk more about that as we head into the investment themes. So just a really quick recap before we head into our next segment. Here are the three forecasts again. Number one, the dollar is going to continue to fall in 2026, just less so than it did in 2025, which supports, certain asset classes. The second forecast is that we expect 3 to 4 rate cuts to keep asset prices supported throughout 2026. And number three, we expect that AI and robotics will remain the dominant structural force in 2026. We're still very early. and the productivity implications for our economy and the global economy are enormous. All right, that's a little bit of the macro backdrop that we provided to our members through our report. Those are 3. We actually had 6. You can find all of them. Our members can find all of those in our latest report we just put out. But now I want to get a bit more practical outside of the economic side. And in segment 2, I'm going to share 3 investment themes where I expect outperformance in 2026. And I'll tell you exactly how I'm getting exposure to them. Hold tight. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, welcome back, friends. We're talking about our 2026 market outlook. We just talked about 3 economic forecasts that we have for 2026. Now let's move into some investment ideas. This is what I really want to focus on here because we released 9 different investment themes that we think are going to be market beating in 2026 in our new report for members. On this broadcast, I'm going to take 3 of those and share them with you, and we'll talk about why we expect outperformance in these areas in 2026. And let's begin with the very first theme that we want to discuss today. And it is one that has got a lot of attention in 2025, but I still feel like it has a lot of room to run. We're still in the warm-up phase, and that's uranium, one of the most misunderstood themes in the market right now, in fact. The core issue here with uranium is electricity. The global electricity demand, if you haven't heard, is rising. Your electricity bill is going up because that demand's going up, right? It's not falling. And that demand is accelerating. Why? Because of data centers, right? AI workloads. We're just seeing a broader electrification of everything. And this is mainly due to AI, right? These AI data centers are power hungry, right? They're very power hungry. And that demand doesn't just go away because you want it to. Even in a slowdown, it doesn't go away. If anything, it grows. So here's the key point. Not all energy sources are equal. Now, we need all energy sources. I'm an advocate of solar and wind and renewables of all kinds, right? But the problem is that, solar and wind, while they're very helpful, and I strongly believe in their future, they can be intermittent until we have better storage solutions. So they don't provide that, base load power all on their own. So you need something that runs 24/7. And that's where nuclear power comes in, right? Nuclear is a scalable base load power supply, and it's clean and it's reliable. And it's one of the few energy sources that can actually meet the rising demand that we see without blowing out the emissions targets that so many countries have done around the world, climate control, climate change. The other piece here, besides the obvious demand for electricity and how uranium can actually solve that, there's also the supply side that you got to think about. Uranium is a long cycle market. And what I mean by that is you just can't flip a switch and bring on new supply, right? It takes years to develop mines. Utilities sign these very long-term contracts, and for a long time, prices were too low to incentivize any kind of new production in this industry. And that created a supply and demand imbalance. that's really still working its way through the system. And that's why I continue to like exposure here through a few specific vehicles. My favorite stock in the uranium space is Cameco. It's been that way for a long time. CCJ, right? One of the highest quality uranium producers in the world. It has scale, lots of credibility, long-term contracts. It's not a speculative junior miner story. It is a powerhouse, right? So Cameco, ticker symbol CCJ, we like that stock for 2026. It had a great 2025. I think there's more upside ahead in 2026. Another stock that we like in this space a lot, and in fact, it's currently our top-ranked smart score stock in the uranium space, is Constellation Energy, ticker symbol CEG. That gives you exposure to the generation side. It owns one of the largest nuclear fleets in the U.S., and as power prices rise and demand increases, this company, I think, is just going to continue to do well. So Constellation, very well positioned. They're the ones who are restarting 3 Mile Island. You might have heard about that, helping out big tech as they build out these data centers. Now, obviously, taking on individual stocks can be risky. So there's also ETFs. The one that I like is the Sprott Uranium Miners ETF, ticker symbol URNM. It provides diversified exposure across the uranium mining space. And, that way you kind of spread out, don't have that single stock risk. Obviously, the uranium space is not a short-term trade. I want to be very clear about that. Uranium is a long-term theme, and it moves in waves. It can be very volatile. We even saw volatility in 25. It went up and down and up and down. But the fundamentals are real, and the demand story is real. So as we look out, we expect uranium to be a beneficiary as an investment theme in 2026. The second theme I want to talk about is cryptocurrency, right? Now, this is a space that, many people kind of get real emotional about. They're either all in or they want nothing to do with it. And I think both extremes are unhelpful. I approach crypto the same way I approach any emerging asset class. I want to know, what problem does it solve? What role does it play? And how do I size it appropriately, right? So let's start with Bitcoin, for example, which, again, I expect to have a good year in 2026. I expected a better year than what we got in 2025. There's all kinds of reasons why I think that we didn't see the price growth in 2025 the way that we had expected. I think that we will see upside in 2026. And when we think about Bitcoin, it really functions as digital scarcity. It's the simplest way to think about it. A fixed supply, 21 million Bitcoin, no central authority, an increasing acceptance by institutions and retail investors as a store of value, and especially in a world of massive debt and, quite frankly, just experimentation with monetary policy right before our very eyes, it really bodes well, I think, to have a little exposure to crypto. This is something we've been doing for well over a decade, right? It doesn't mean that it replaces everything. It just earns a seat at the table, basically. Ethereum is a little different. That's another one that we like. It's really infrastructure, right? It's the base layer for decentralized applications and smart contracts. So if Bitcoin is digital gold, we would say Ethereum is more like a digital operating system. We might call it that, right? Then there's Solana, which we also like. Solana focuses upon speed and scalability. It's built to handle high transaction throughput at relatively low costs. And that matters a lot whenever you're, a company that's trying to create, consumer-facing applications or payments or financial activity. You want to move it quickly. Well, Solana offers a real solution. Now, these are just 3 of the cryptocurrencies that I own and expect to do well in 2026. But there's obviously risk, right? It's obviously a very volatile space. It's going to remain volatile. Anyone telling you otherwise is not being honest. But it's also increasingly institutional, right? We see ETFs, we see custody solutions, we see corporate adoption, right? We're beginning to get regulatory clarity, the Clarity Act, supposedly coming here in the next couple of months. We're all seeing this move in this one direction. And especially as we begin to get rate cuts and more liquidity into the market, when the financial conditions continue to ease in 2026, you tend to see speculators and alternative assets kind of tend to benefit, right? So speculative assets and alternative assets, people will start to, speculate. And again, that doesn't mean that crypto is going to go straight up. it means that we're going to have a tailwind, right, in 2026. So my approach here is to have some exposure. I've told you from the very beginning with crypto, I like a 5% allocation to the digital asset space. I hear now that Bank of America is advocating for its wealth clients to have a 1 to 4% position in the crypto space. I think that's perfect. I think 5% is fine. If you want to have more than that, just realize you're taking on a lot of potential risk, and you got to be willing to sit through some pretty massive, nasty drawdowns, right? But just having some exposure makes a lot of sense. But not obsessing about it, right? Making sure you have a good position size in the space. It really shouldn't dominate your portfolio, in my opinion. But if you ignore it entirely, I think that carries a massive opportunity cost that you probably don't want to have to pay. Now, that's the second theme. Let's talk about the third theme, and then I want to talk about a few of my favorite stocks for 2026. The third investment theme that we expect to outperform the S&P 500 in 2026 is much simpler. It's the NASDAQ 100 index. This is my niche. This is what I focus upon when it comes to trading, and I have a long-term position in the NASDAQ 100. I think it's one of the very best ETFs that gives you exposure to 100 innovative, non-financial companies in the United States. These are some of the most profitable, innovative companies in the world. And these are companies that have real earnings, strong balance sheets, global clientele. And if you look at the NASDAQ 100, constituents, if you look at the actual stocks in the list, there's 100 of them. They're very heavy in AI, right? In cloud computing and software, semiconductors, digital advertising, digital infrastructure, all of this, you can really get in that single ticker. I use QQQM as opposed to QQQ because it's slightly lower in terms of expense ratio, but it's the same holdings. So I use QQQM. That's a long-term holding for me. I like to add to it on pullbacks, and I like the fact that it doesn't carry any single stock risk, right? So I don't have to wake up in the morning and find out the company is, having a terrible report come out or whatever. It's not going to impact the ETF that has 100 stocks in it the way that holding that single stock would. But it still can be volatile, right? Don't get me wrong. I've sat through some pretty sharp pullbacks in the NASDAQ 100 over the last many years, but my patience has been rewarded. So I like to gain exposure here through the Invesco NASDAQ 100 ETF, that QQQM. It's simple, it's liquid, and it captures a lot of the innovation in one single ticker, right? I like that. So anyway, that's the third investment theme that we expect to beat the S&P 500 in 2026. Recapping those, we said uranium, which we like, Cameco and Constellation Energy and Sprott Uranium Miners ETF. We like the crypto asset space. We like Bitcoin. We like Ether. We like Solana. And then we also like the NASDAQ 100. We think all of these are going to outperform the S&P 500 in 2026. Now, before we wrap up this segment, I also want to share just a few of my favorite stocks for 2026. This year in my report that I put out for the 2026 Market Outlook, I included well over 50 stocks that were my favorite for this year, and I broke them down by sector. So I put my favorite tech stocks and my favorite utility stocks, my favorite basic materials stocks, my favorite healthcare stocks, favorite energy stocks, all that. So you can just get into that report. You can see all of those stocks. These are stocks. See, I'm a growth investor, so I like to invest in things that have a good probability of growing strongly over the next many, many years, because I'm going to sit for 10 to 15 years in these stocks, and I want them to do well. You can sit in a stock and it goes nowhere for 10 years. I don't want those kinds of stocks in my portfolio. I'm looking for growth, right? So obviously I'm looking for companies that have growth. And I'm going to share with you a few of the companies that I think have a lot of growth ahead still. And I'm going to share with you about 4 stocks. Okay. But again, just for the sake of time, I don't want to go through like all 50 of them. That's for our members. You can go see all of those. It's a great list to begin your research with if you're looking for good companies for the new year. But let's just talk about a few of these. As I mentioned, not a full list. These are just a few examples from the report, and it'll kind of provide you a window in my thinking It's not really a checklist that you should copy. I'm not saying you should go out and buy these stocks. Right? I don't know what you should buy. You should always talk to a trusted financial advisor before you make any financial decisions. But with that said, let's start with one of my favorite tech stocks this year. Not my favorite, but one of my favorites is Micron. Ticker symbol MU, right? Micron gives you exposure to memory and storage, right, in the computer hardware space. Obviously, very cyclical businesses, right? And right now, the cycle, if you look at it, it's really improving. Micron had a monster year in 2025, and I think it's going to do the same thing again or similar to it in 2026. AI, cloud computing, all of that requires massive amounts of memory and storage. And that demand, again, is not just going to disappear. Even if we have a slowdown, it's just going to keep compounding. And Micron tends to do well when memory pricing improves and the capacity tends to tighten. And if you look at what Micron's been saying, they're just simply, they're simply saying that the demand for their product is simply too strong right now. So it's kind of creating a constraint. So for 2026, I like Micron, ticker symbol MU, as a way to participate in the infrastructure side of artificial intelligence, not the hype side, right? But the actual real money-making infrastructure side of AI. Micron, ticker symbol MU, one of our favorite tech stocks. Now, let me turn to one of our favorite consumer discretionary stocks, and it's one that I own. So in full disclosure, if I own a stock, I'll tell you on this broadcast. I do own Amazon. Amazon, ticker symbol AMZN. One of my favorite stocks for 2026, even though I already own it. And I've been buying more of it lately. Our members know that because I share all of our latest buy alerts with our members. But when you look at Amazon, Amazon.com, it's one of the most misunderstood businesses by many people because it's looked at like a glorified bookseller. It's like a glorified bookstore online. But it's not just an online retailer, right? Retail is almost what we would say is just the front door. The real engine to Amazon is cloud computing through AWS. It's logistics at a massive scale. It's automation and AI-driven efficiency. So Amazon is constantly reinvesting its profits into lower costs and to improve their delivery systems. And when that kind of thing shows up in their margins, then earnings will quickly follow. And so for 2026, I think Amazon is a productivity story that's going to continue to improve, and that's going to translate into a growth story. Amazon actually didn't do so well in 2025. It didn't go down that much. It just didn't go up very much either. Just kind of stagnant. I think that could change this year. I think the market is underestimating what the future for Amazon is. And I think that we could see a repricing of that stock over the next year or two as people begin to realize what this company is actually doing. It's a huge AI story that many people are not thinking about. So Amazon.com, one that I own personally. And it's also part of our Smart Score 11 strategy as well. In fact, it's been our top consumer discretionary stock in the Smart Score 11 strategy since the beginning of 2024. So it's been there for quite some time. Now, let's move on to the healthcare space. And I have a few of my favorite stocks in that space, but the one that remains one of the most dominant, in my view, as we head into the new year is Eli Lilly. Ticker symbol LLY. It has a leadership in the metabolic and weight loss drugs that's really changed the whole conversation in healthcare. This has been a huge, huge thing in the healthcare space. Weight loss is just one of the biggest markets, right, that there is. And but it's not just about vanity weight loss. That's not what I'm talking about. It's really about diabetes and cardiovascular risk and long-term health outcomes. The demand is real, and if you look at the pipeline for this company, it is very strong. The pricing power that this company has is very significant, and it just continues to innovate. So as a powerful combination, Eli Lilly, our top-ranked healthcare stock in the Smart Score 11 strategy, and that one is one that we really like in 2026 again. And we do like healthcare right now in particular. We've been noticing it rising in the ranks in terms of the sectors. And we think it's time for an outperformance in healthcare. Could be the year. And if so, Eli Lilly is very well positioned to dominate. Let me give you one more stock. As I mentioned, for the sake of time, we could go many, many, many stocks. But I'm going to just do one more here. And this is our top industrial stock. Now, there's lots of different types of stocks, that you can focus upon. But when it comes to the actual industrial space, let me talk about one stock that stands out to me, and that's Uber, ticker symbol UBER, right? Uber, when people think of it, it's actually a verb. It's not like Google. Google kind of just became a household name. It's like, you Google something, it's literally a word in the dictionary now. And talk about a good thing for your brand. Well, same thing with Uber. When you call an Uber, it may be Lyft, it may be Uber, it may be Waymo, but the word has really stuck, right? So the Uber of today is not the Uber of 5 to 10 years ago. It's no longer this cash burning experiment to see if people will actually use something besides a taxi. It's a platform business. They have improving profitability, mobility, delivery, logistics, advertising. Uber touches all of it. And what I like here for 2026 is the fact that we're seeing its margins improve, right? At the operating level, we're really seeing some good growth. And the market is finally starting to value Uber as a real business instead of like this conceptual idea that it was for so long. And we're seeing that shift. And so I think Uber is very well positioned for a very good year in 2026. It's one of the better run companies in the industrial space as we begin to see it emerge from this kind of time frame where people didn't take it too seriously. It's beginning to change. Uber looks really interesting as we head into 2026. So when you step back, you'll see we're covering different sectors where some of these have different risk profiles, but they're all tied to the same thing, long-term demand, not some sort of short-term hype, short-term narrative. No, we're looking for these long-term growth stories. Micron, we think, is a great tech stock in 2026. Amazon, a great consumer discretionary stock in 2026. Eli Lilly, a top-rated healthcare stock for 2026. And Uber, one of the top industrial stocks as we head into 2026. Now, these are not the only stocks that I like for 2026, as I mentioned. They're just examples. The full framework, including how I think about all the different sectors and all of those investment themes and all of those economic forecasts, are all right there in our 2026 market outlook for all of our members, available on our website right now. If you're not a member, go to followthemoney.com/join, choose your plan, and get access to our 2026 market outlook. Get the whole thing, all the stocks, all the investment themes, all the economic forecasts, and then a companion video that goes right along with it where I break down and explain everything in the report. So let's make it a great year ahead. We'll be right back with our final segment. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. It's been great to have you here today. We've covered a whole lot, but now I want to zoom out for a moment and remind you of what really matters. Markets are uncertain by design, right? If they were easy to predict, then there would be no reward for patience and discipline or humility, none of it. They would reward certainty, and certainty is usually an illusion, right? That's why I keep coming back to the same idea year after year, that it's not about being right all the time. It's about being positioned reasonably well when the future unfolds in ways that none of us can fully expect. In 2026, as I look forward, my posture is constructive, but not being reckless. I'm optimistic, but I'm not closing my eyes to the risks that are involved. I remain invested, but I'm always aware of the risk that's involved in being invested, right? But I got to admit, I like an environment where inflation is beginning to cool and rates are beginning to ease and productivity is on the rise. And I like all of that. I like exposure to the long-term forces of technology and innovation. And I like owning real businesses and real assets that generate value over time. But here's the part that matters even more. None of this works if you let fear or greed run the show. The biggest mistakes I see investors and traders make are emotional ones. They panic during drawdowns. They abandon good ideas at exactly the wrong time. You don't need to catch every move. You don't need to own everything. You don't need to react to every headline. What you do need is a framework. You need a process, and you need patience to let that process work. And that's really what the 2026 market outlook is all about. It's not a list full of predictions, right? It's a way of thinking. It's a way of filtering noise. It's a way of staying grounded when the markets are getting loud. If you're a member here at Follow the Money, you already have access to the full PDF and the in-depth video where I walk through everything in detail. If you're not a member, however, and this is the kind of thinking that resonates with you, I'd love to have you join us. But regardless of what you invest in this year, I want to leave you with something that has nothing to do with the markets, because as important as money is, it's definitely not the point of life. This is the first episode of 2026. We have a new year, a fresh chapter, and one of the lessons that keeps coming back to me is this: the days can feel long, but the years move fast, faster than we realize when we're living through them. So as you think about your investments this year, don't forget to invest in your life too, in your health, in your relationships. Invest in those moments that are not connected to a balance sheet or a cash flow statement. Money's a tool, friends, but time is the real currency. And I want to leave you with a short final word that captures that idea perfectly. Roll the tape.
I'm 80 years old, and somehow I woke up in my 32-year-old body just for one day. I wake up to little hands tugging at the blankets. Mum, wake up, they shout. I blink and I sit up slowly. My babies, they're small again. They climb into bed, giggling, wiggling. I remember rushing through mornings, but not today. I pull them close, I hug them tight. I kiss their messy hair, I hold their little hands. This time, I soak in every second. I catch my reflection in the bathroom mirror. No deep lines, no grey hair, my younger face. I used to think I looked old at 41. What a silly thought. I find my husband in the kitchen making coffee. He looks strong and he looks young. I wrap my arms around him tightly. He looks surprised. Maybe we didn't hug enough back then, I think. We talk about the day, and today it all feels big. I memorize the sound of his voice. We pile into the car, kids arguing over seatbelts. Someone drops a snack, there's crumbs everywhere. I used to get so frustrated, but today I soak in the noise and the chaos because I know my car will be quiet and spotless for many years to come. Dinner is loud and unorganized. No one wants to sit still. There's shouting, giggling, arguing, and so much life. I don't clean up straight away. I just sit and I watch, trying to burn it all into my memory. Before bed, I pick up the phone. I call my mum and I hear her voice. I haven't heard this voice in so many years. I close my eyes and I let her words wash over me. I tell her I love her again and again. I never want to hang up. And this time, I don't leave anything unsaid. At bedtime, I don't skip pages in the story. I read every single word. And then I ask, can we read one more book? And they say yes. I don't want this day to end. I got one more day, and this time I knew that this was joy, this was love, those little hands, our strong young bodies with no aches or pains, our parents who are still alive. It all mattered so much more than we ever realized at the time.
That's powerful stuff, friends. You know, life has a way of sneaking up on us. The days can feel slow and routine and repetitive, but somehow the years just pass in a blink. So in 2026, I encourage you, don't rush past the moments that matter and take time to notice what's right in front of you, the people that you love, and the simple joys of life. Build wealth, yes. Plan wisely, think long term, but don't miss out on the journey while you're doing it, because time is the one asset that none of us can compound, so use it well. And that is just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Happy New Year to you and yours. God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.